Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've seen and had a look at the latest spending numbers coming through in the economy, and perhaps surprisingly, we've seen a little bit more of an upbeat tone than we might have expected fairly quickly, considering that, normally it takes a while for things to come through in the economic numbers.
Yeah, over the last 3 months, we've seen electronic card spending up by 1.5% from its low point. That's the value of spending. It's still well down on its peak back in early 2023, when it's still around about 3% down from where it was at that point in time, reflecting the sort of long downward trend in spending that we saw through 2023 and the first half of this year. But yeah, starting to pick up, and our expectation had been around household spending that yes, okay, lower interest rates will help, but it will take time. I mean, when we look at the figures, people are still rolling off some lower fixed mortgage rates from 3 or 4 years ago onto higher ones. Yes, people are rolling off from 6 months ago onto lower ones, but you add all of that up, and there hasn't really been a lot of a positive impact on people's budgets and the amount of money they've got free to actually go and spend on other stuff from those mortgage rate cuts coming through yet. You also overlay that with the fact that the unemployment rate's still trending upwards, 4.8% in the latest quarterly figures as well, and expected to continue rising. Job losses over the last 12 months of about 0.4% as well, the first decline in 12 years in terms of those job numbers. And it is, to me, a little surprising that households seem to have reacted quite so quickly in terms of lifting spending. Again, not a huge lift, but it has been a gradual one over the course of 3 months. A little bit inconsistent with consumer confidence, which is still languishing at low levels, but maybe just a few positive signs there from a business point of view that, this may be the sort of bottom for the economy and things just starting to turn around in the right direction.
And I think as well, right, it's not like the economy is absolutely sort of, stonking along with huge amounts of spending. Households are not sort of, absolutely living it up. But I think instead you've seen, like you say, a bit of a lift the last couple of months. Spending activity still down on where it was a year ago. Per person spending still not fantastic. But again, just a little bit of that sort of the early signs of those greener shoots. And I suspect as well, I mean, you've talked about, of course, how mortgage rates will have come through. You do also have, though, of course, the fact that households have received, a lot of them, a bit of a tax cut. Not huge by any stretch of the imagination, and not a lot to sort of drive things around, but also less inflationary pressure. Inflation sort of now back towards that midpoint of 2%, 2.2 in the September quarter compared to a year ago. So all combined, you've got sort of less intense mortgage rate pressure, not hugely, but just coming off a bit. Less intense inflationary pressure, tax cuts coming forward, maybe a little bit earlier than expected, but again, just pumping up a little bit more activity through and things. I guess it's interesting as well, right, when you look at the likes of those consumer confidence figures, you're right, they're not awesome. Business confidence, on the other hand, has sort of skyrocketed. Everyone's very happy, looking at conditions a year ahead and going, actually, there's much better things to be had. But for consumers, they're sort of saying, look, still not awesome. And when you do look at sort of the difference in future and current conditions there, a lot of households saying, look, it sucks at the moment. It's pretty tough. I'm still worried about those job losses. I'm still just worried about the economy in general. But the future numbers are higher. And that's actually sort of unusual. If you look back sort of 2018, 19, Kiwi households were saying that they were more confident about current economic conditions at that time than they were about future expectations. Now everyone's sort of hanging on to that idea of survive till 25. Now, if you're starting to see those consumer spending figures lift a bit, probably a bit earlier than we might have expected, you've still got the unemployment rate rising, though, and job losses coming through. What does that sort of mean for the economy? Does it mean things are actually going to pick up a whole lot faster? Is there maybe not as much need to cut interest rates quite as aggressively next year? Or again, is it just a bit early to tell and it's sort of touching up off the bottom, but sort of not immediately sort of enough to worry about or to completely change direction on?
Yeah, I'd say it's probably the latter one. The jury is still very much out in terms of whether this is an upward trend with any sort of guts to it that's developing, or whether it is just a case of things bottoming out and it being, several months yet before we start to see a stronger upward trend. I mean, my view would still be that it's probably patchy growth out there in terms of how the economy goes. And in terms of inflationary pressures as well, I expect the Reserve Bank is still going to be leaning towards let's, provide more, well, not necessarily more stimulus for the economy, but sort of less contractionary interest rates. Remember, that OCR is still above neutral at current levels as well. So it's a case of watching the data closely, I think, over the next 3 months or so, just seeing how that trend in spending develops and whether there is more guts to it, more momentum. That means that we can be confident in the early part of 2025 that this is the sort of genesis of the economic recovery, rather than just, we're at the bottom and still waiting for things to start to come up again.
We've also seen some quite different trends in how that spending is coming about, as too. When we sort of looked into that, the likes of consumables, so often your sort of supermarkets, your necessities, your staples that you have to consume sort of over a fairly quick time period, those have sort of been fairly solid. The likes of sort of more durable items, though, your bigger, not as needing to be replaced quite as quickly, your electronics, your lounge suites and that, again, spending hasn't been particularly upbeat on those. The two areas that have seen a bit of a shift in recent times look like they've been both hospitality and apparel to a degree. So again, a bit more clothes shopping out there. Again, not enough to really sort of show that things are getting huge amounts better all that quickly, but just again, a little bit of a shift maybe in household priorities where they're going, look, I'm still getting the stuff I need. Now I'm starting to feel a little bit better, not hugely, but a little bit better, putting some money on some of those lower value items that I couldn't spend on before, going out for a nice lunch or dinner or whatever it might be, going in and getting a new shirt, a new dress and some new shoes, but sort of not still willing or able to commit to some of that bigger stuff, doing DIY, buying big furniture or anything like that. So again, bit of prioritization that's quite smartly happening across a number of households. We'll continue to assess how all of those different spending trends go, how households continue to adjust, and just how good those Black Friday sales might be on one of our future editions of Econ Talks.